their little soapbox. The crash is coming. Look at all the data that I fully understand the economic circumstance. The trillions of dollars moving around on a daily basis. Bullish, baby. Today, folks, this is hands down one of the oddest markets I've ever seen in my entire life, and we are heading into an even more interesting cycle when the interest rates start getting cut, especially in the United States. We're going to go over so much data. I want to talk about delinquencies on mortgages, all the bearish sentiment that you've been hearing over the last week that has slowly dissolved because the data is just so surreal. Like, we just got this, that jobs data could be off by 1 million when Labor Department revises figures because, you know, they screw up and they miscalculate. And these reports have been coming out that the U.S. added 818,000 fewer jobs than believed. And the funny thing is it's still bullish. And why is it still bullish? Even though the jobs report has been wrong, and you look at this data and you're like, oh my God, we're not getting a whole lot of jobs growth. And this is probably going to make the Fed scared and cut rates sooner. And it's more fearful in the market, and it just means we're closer to a recession. But when you zoom out on the max chart, we're still in a very nominal place for job growth, even though it's starting to get minimized. And yes, this data isn't something we want to see supported over the long run, but take a look at some of this other data like delinquencies. So this is delinquency rates on credit card loans in all banks, and it has been going up consistently quarter over quarter in Canada as well. It is a huge concern that a lot of people have been driving into that bear case, but then you zoom out on the 5-year and you're like, oh my God, we're hitting 5-year credit card delinquencies, but you hit that max and we are so far below historical averages. Yes, are we higher for the past decade? Sure. But when you go back to the historical aspects of it, this isn't a trend, again, we want to see continuing, but we are not in a terrible place or anywhere near a terrible place yet, right? And then I look at like delinquency rates and single family residential mortgages. These are people like you and me. Interest rates are high. Is it absolutely calamitizing the entire real estate market? Well, if we look, it's starting to go up. Oh my God, since Q4 of 2023, this has been a horrible year in 2024. It's been nothing but going up. Delinquency, oh my God. And then you zoom out on the max and you're like, oh, well, we are still at historical lows, even going back to like the 1990s. Like, you know, and then like you take a look at something like money market funds right now in a time where the S&P 500 is hitting an all-time high. It is starting to flirt with the idea of there's more money out there still. Here we sit with more cash than we've ever seen on the sidelines that isn't going to be on the sidelines for much longer as we head into an interest rate cut cycle, right? I mean, you look at people like Warren Buffett that is just putting huge amounts of cash, more than the Federal Reserve has in treasuries, right? And that's just because if I can still make a consistent 4 or 5 or maybe even close to a 6% return, just by buying money market funds and stuff, I'm going to keep doing that because it's just an easy place to get a guaranteed return on trillions of dollars. I mean, 6.4 trillion to be exact. I mean, it's a crazy amount of capital that has just been accumulating, and we still are hitting an all-time high. There's so much money in the U.S. markets. It is damn near jaw-dropping, and this comes at a time where I like to share with you the value of the dollar. The US dollar continues to remain stronger than it has been. If you zoom out on the chart here, because everyone's like, oh, the US dollar and debt and all this stuff. There's been more demand for USD than there has been since basically the early 2000s. I mean, we're talking about more than 20 years that the dollar, even with all the money they printed and all the debt and all the problems, they are sitting at record level. They're sitting at 20-year record levels, right? That they haven't seen in value. I mean, it's kind of nuts. This is why if you live in Canada or any of these other countries, your dollar's been, for the most part, deteriorating because the U.S. is the strongest currency in the world. And it's just, again, bullish. And I want to remind you that bears always get sent to slaughter. And I want to take a listen to this, and then we're going to talk about the broader markets and just talk about some stocks that I promise you're going to blow your mind. But take a listen.
The fact that we snap back so sharply is showing you how strong this market is.
Still.
Yes.
The revisions yesterday, not on your radar. Should they be on investors' radar screen? I thought it might be a good thing if the job market was not as hot as people thought.
Yes, I think it is incrementally important because the FOMC minutes that came out yesterday as well showed the Fed staff saying this is a strong labor market. Well, that jobs report that came out Friday and the revisions that just came out show a lot of jobs disappeared. It's not as strong a market, and I think it gives more ammunition for the Fed to start a cutting cycle, and that's going to give a lot of life to the economy.
And to the markets.
And to the markets, especially cyclical stocks and small cap stocks.
Tech's already done well. So normally you'd think, or multiples could or at least multiples don't need to stay where they are or contract with a high multiple tech stock. So they could at least feel better about the valuations if rates came down.
Yes, that's right. I think tech is still in a good place because of AI, and NVIDIA should reinforce that. And it's not a demanding multiple. NVIDIA is maybe 28 times forward earnings, which is for the best, one of the most important companies in the world. It's not a high multiple. So if tech is in a good place and then we get Fed cuts, I think it allows the overall market to expand.
So I actually think interest rate cuts are better for big tech companies, especially ones that are trading at favorable values like Meta, like Google, because, you know, especially in the advertising world, when people have more liquidity and they have ads that are working, they will use that liquidity, but they might not take the risk if their credit cards, their line of credits, their margin, wherever they're getting that capital is at 9 or 10%, like my line of credit currently is. Like, it's exuberantly high. He makes a lot of intriguing points, right? Like we said with the data on the jobs, presuming jobs don't go negative and we stay in the situation that we're in, and this is probably putting a little bit of fear in the Federal Reserve to hopefully start cutting rates sooner, but we are still in an incredibly strong market. And there's a few other data points that I want to go over here because, again, I think the lower half of the market has been my big bet. It's why I've been buying dividend stocks in the lower half oriented stocks in these ETFs like SCHD and some of the utility sector ETFs, because I think people are going to start chasing yields in those aspects. And as he mentioned, even in the small cap realm of things, people might be more advantageous. They think there's better value there, which there is, because I don't think there's huge value in tech. Microsoft, Apple, these companies are incredibly valued. They're not actualizing the AI revolution, even though it seems like they are, you know, with ChatGPT and all this stuff. But Microsoft isn't seeing that hit their bottom line yet. They're trading at absurd multiples for where they have historically for the revenue and earnings that they've been generating. So you got to be a little cautious with tech here, in my opinion. Not that I'm bearish on it by any. I think you could see a correction, but maybe not like a huge crash. We could see a bit of an AI bubble burst, especially on the lower half of the market. But what's also very intriguing here is oil's gotten a lot cheaper in a market where oil demand has been hitting record highs, which is a really interesting. And then keep in mind, the commodities are largely manipulated, in my opinion. But I'm shocked that oil's been trading down at the levels it's been trading down. And the reason I say that is, again, not only is oil use at record highs, but when you look at TSA checkpoints on travel numbers in the United States, I always kind of use this as an indicator, because when people have extra cash, you know, if they're not too strapped, or they're going to want to travel. We all like to travel, right? Especially coming out of the pandemic. And we continue to hit, for as far as I can tell, every single month for most of the year, every single day. I mean, these are literally day over day data points. And the number of people traveling is still accelerating year over year. And this is a sign, in my opinion, of a booming economy. There are a lot of people coming into the U.S., a lot of people in the U.S. traveling. There's just so much going on that this, again, spurs more GDP growth, more spending, more oil use, more all this stuff, right? So I'm really curious to what's going on with oil, maybe productions. I'm not an oil expert. I'd presume that, you know, supply and demand, right? Which means there's more supply in the market than there is demand for oil. Why, how, who the heck actually knows? But what this translates to when we look at the rest of the markets right now is bullish, 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 baby. Look at this. The Russell 2000, baby. I mean, is up 7.49%, lagging everything. The Dow is up 8.31%. The NASDAQ up 21.3%. The TSX up 10.39%. Even on the Canadian side of the border, we are starting to excel. Is the NASDAQ really up that much? Do you know how crazy this is, these numbers? I mean, they're absolutely absurd. When I'm scrolling through my market here, my watch list on StockTwits, I am still like flabbered by how strong, even these down days, they're very weak, and they've always keep presenting buying opportunities. And I just can't get over how bearish people were just like a week or two ago. You want to know how bullish this market is? Look at these grandpa stocks, in my opinion. These are stocks that have been around for a while. They become very suppressed. I mean, you look at PayPal, this is a very famous one. There's got a lot of competition. The stock is up. Like, how much is PayPal up? 19% now year to date. General Electric, the grandpa of the grandpa stocks, is up 70% this year. 3M, after all those lawsuits. I mean, this is a huge general manufacturing company here. I mean, 40%. British American Tobacco, 21%. And BTI was paying like an over 10% yield. And look at it. Look at it. It's a friggin' 20% in capital returns if you bought beginning of the year. Kimberly-Clark, 18%. These companies are acting like tech companies. And again, we haven't even started an interest rate cut cycle yet here, folks. And the broader markets are just starting to benefit greatly. Let's take a look at the heat map here and just see what the year to date looks like, because I don't think there's been more bullish sentiment I've ever seen. If you take a look at the 6 month here, look at this. Outside of few and far in between, like Disney, which deserves to be getting clobbered with their crazy lawsuits and what you sign up to when you get Disney Plus, I'll leave that to the people that have dug down that rabbit hole. But look, I mean, look at this. I can't get over. This is why I never stop buying stocks. That's why I'm always buying, folks. This is why idiots, on their little soapbox, the crash is coming. Look at all the data that I fully understand the economic circumstance of trillions of dollars moving around on a daily basis. You're going to sell. You're going to thwart. We're going to make a lot of money thwarting the market with options, baby. Did it work out? No, hell no. Never does. But I'll pass the question off to you. I'd love to know what you think in that comment section below.